A company most retail investors had never heard of just moved 22% in a single session on a Thursday. York Space Systems, ticker YSS, printed that gain on volume roughly 4 times its trailing 90-day average. That is not noise. That is someone with a large checkbook making a very deliberate decision. The question that actually matters is not whether you missed this move. You probably did. The question is whether understanding why it happened can make you meaningfully better at catching the next one before the headlines arrive. Let's establish exactly what happened before we editorialize. York Space Systems operates in a segment that sounds futuristic, but is deeply tied to government procurement cycles. Specifically, the Department of Defense's push to diversify its satellite architecture away from large, expensive, single point-of-failure platforms toward constellations of smaller, cheaper, more rapidly deployable spacecraft. YSS manufactures what it calls the S-class satellite bus, or a standardized modular structure that allows payloads to be integrated quickly and launched on relatively short timelines compared to legacy primes like Northrop or Boeing. As of June 2026, the catalyst driving today's session appears rooted in contract news, specifically reporting that YSS secured or materially advanced a Phase 2 contract award tied to Space Force, proliferated low Earth orbit architecture programs. These aren't speculative defense contracts. Proliferated LEO, or PLEO, is an active, funded DoD priority designed to reduce adversary targeting risk by distributing satellite functions across dozens or hundreds of nodes rather than a handful of expensive geosynchronous assets. When contract news of this type drops for a smaller cap name, institutional algorithms and sector-focused funds respond fast, especially when the company already has Phase 1 credibility. What you're seeing in the volume spike is not retail euphoria. It's fund managers recalibrating position sizing against a probability event that just materially resolved in the company's favor. The actionable insight here: contract stage transitions from Phase 1 to Phase 2, from development to production, are among the highest signal catalysts in the defense space sector. Learning to track procurement pipeline announcements from SAM.gov and DoD news releases before they hit financial media is genuinely how edge gets built in this space. A 22% single-day move demands one honest question: did the intrinsic value of this company actually increase by 22% today? Almost certainly not in a strict, discounted cash flow sense. But that framing misunderstands how defense sector equities reprice around contract milestones. Here's the logic the institutional side uses. Defense contractors at the emerging growth stage are valued less on current earnings, which are often minimal or negative, and more on contract backlog, visibility, and total addressable market capture rate. A Phase 2 DoD contract does 3 specific things to a company's risk profile. It validates technical capability with the most demanding customer on Earth. It creates a revenue stream with high certainty and predictable payment schedules, and it substantially increases the probability of follow-on production awards, which are often orders of magnitude larger than the development phase. For a company the size of YSS, this is not a Lockheed Martin. Even a single mid-sized production contract can be transformative at the revenue line. When the market is trying to price that optionality shift in real time, a 20+% move is not irrational. It may actually be conservative, depending on contract size and competitive positioning. What beginners consistently misread is the difference between a move that looks expensive on a price chart and a move that is expensive relative to forward business fundamentals. These are completely different questions. A stock that has run 22% on a contract catalyst is not automatically overextended. It may simply be repricing to a new probability-weighted reality. That said, and this is not financial advice, chasing any stock The session after a gap of this magnitude carries asymmetric risk. The smart move is to understand the story first, then build a framework for entry on your own terms and timeline. Let's talk about the behavioral pattern that will cost you real money if you don't internalize it now. When a stock gaps up 22% on news, two instincts dominate retail behavior. The first is FOMO, the fear that this is a transformational move and you are permanently left behind if you don't buy in the next 48 hours. The second is reflexive skepticism, the assumption that any big, single-day move must be a pump, a manipulation, or a narrative that will collapse within a week. Both of these responses are wrong, and they're wrong for the same underlying reason. They substitute emotion for process. The investors who consistently build wealth in names like YSS are not the ones who bought on the day of the spike. They're the ones who had already done the work on the business model, knew the contract pipeline, understood the sector thesis, and were positioned before the catalyst arrived. Today's 22% was their reward for preparation, not luck. For everyone else watching this video right now, here is the actual useful lesson. Post-catalyst spikes in small-cap defense and space names frequently consolidate for weeks or months before the next leg moves. The institutional buyers who moved today are not in a hurry to flip their position. They bought because they believe in a multi-quarter thesis. If the thesis is sound, there will be a better entry than Thursday's close. If the thesis is not sound, the spike will fade and you will have protected yourself by not chasing. The discipline is this. When you see a move like YSS today, treat it as a research trigger, not a buy signal. Put it on your watch list. Read the actual contract announcement if it's public. Understand what the company does at a mechanical level. Model out what a production contract could mean to revenue. Then decide. That process, not impulse, is what separates the investors who compound from the ones who donate to those who do the homework. The space economy is genuinely one of the most structurally interesting investment sectors of this decade. AI-driven satellite analytics, dual-use commercial military architecture, and the ongoing democratization of launch access are creating real fundable businesses. YSS is one data point in a much larger map worth understanding. We opened by asking why a company most people had never heard of just moved 22% in a day. The answer isn't mysterious. It's a defense procurement cycle behaving exactly as it always has, just in a sector most retail investors have never bothered to map. The more interesting question: which other small-cap space and defense names are sitting one contract announcement away from a move exactly like this? That's the next video. Subscribe so you're there before the spike, not after it.